Hi everyone, it is January 19th, 2019. So it is said that there are two emotions that drive all markets, fear and greed. But I would like to think that they are really fear and fear that are driving the markets. The first fear, I call it fear of getting killed, or spelled as FOGK. For those of you who want to sound it out, you can sound it out yourself. See what it sounds like, FOGK. Now, the second fear is called fear of missing out, FOMO, or as FOMO. Okay, to me, these are the two powerful emotions that are underlying all the major market movements. Now, let's talk about greed and fear first. Okay, why I believe that it's fear rather than greed. Okay, greed, as we all know, greed in my mind, it's really a minor form of fear of missing out. Okay, what that means is that greed is it's type of emotion that move for you to move towards something. Okay, you want to gain something. And whereas fear, it's emotion try to avoid pain, avoid something, whether this pain is real or imaginary. So fear of missing out, because it's fear, it's a much more stronger emotion than greed, which is a move toward emotion. So fear is a moving away emotion, and greed is a moving toward emotion. Now, when you miss out on something, sometimes it's not just profits that you're missing out. Sometimes if you let's say all your neighbors are in this hot stock or in this kind of buying houses. Let's say we're back in the housing mania, and you're the only one not getting into it. So while everybody else is making money, everybody else is looking smart, and in the meantime you don't have anything, you might start to feel that you're stupid or you're not adequate or so on and so forth. So it's the fear of missing out that will compel people jumping into things that they have no business jumping into. Force them to fear, forces people to act irrationally. Okay. Now, sometimes people also say that the market is driven by fear and hope. Okay. Hope is another powerful emotion, supposedly. But if you think about hope, what is hope really? Hope, in my mind, it's really a combination of a little bit of FOMO, a little bit of fear of missing out, a little bit of fear of getting killed. Now, usually hope comes in the form of when you are holding on to a losing position. Okay, this is what happened. Let's say you own a stock, it's going against you. Okay, it started going against you, and but it's not going that badly yet. It's not going against you so much to the point that you have to get out no matter what. In other words, you experiencing a little bit of fear of getting killed, but it's not enough that it compels you to ditch the position altogether. However, the reason you don't want to get out is because in the back of your mind, you are wondering, hey, since it's going down already, it's going down so much already, maybe the stock can turn around at any moment. And if I get out right now, I'm going to miss my opportunity to make my money back. So I have this fear of missing out. I'm fear of missing out, the potential turnaround and the potential profit, because the moment you're out of position, it's very hard to get it back again. What if the market just took off without you? The stock took off without you once you get out. So if you look at all these, look at all these behaviors. So there are really only two fears in the market: fear of getting killed and fear of missing out. Okay, and fear really is the only rational explanation for the sometimes huge and wild, crazy behaviors in the market. Okay, so right now, let's look at this. Right now, we are looking at a stock chart from October 2007 to March 2009, and we all know what happened back then. We call them the Great Recession, and the market basically just pretty much crashed. It was a pretty big bear market. Okay, this is fear of getting killed in action. All right, and okay, so right now, what we have, in addition, I want you guys to think about this. In addition to fundamental analysis and technical analysis, now we also have something called the market sentiment or market psychology analysis. And these are primarily based on the fear of getting killed and the fear of missing out. If we understand this, now we can analyze and look at the market from a whole new and additional perspective. Okay. All right, let's look at the next thing. Now, next thing we got to know is that these two fears, they operate in all and different time frames. So let's go back to this chart again. The weekly chart of S&P 500 from October 2007 to March 2009. So we mentioned before, this is a fear of getting killed in action. When the fear, in this case, when the fear of getting killed in action, when the fear of getting killed lasting longer, lasting month, sometimes even years. Okay, from October 2007 to March 2009, that's a little bit over 1 year already. Okay, that is a long term. When we have fear of getting killed in a long-term time frame, guess what we call them? We call them bear markets. Okay, but they also operate in shorter time frame. Look at this right here. So here we're looking at a chart, still S&P 500, S&P index, the daily chart, but this time look at the ones I highlighted. Okay, especially the down arrow from July 27, 2017 to August 21st, 2018. This thing only lasts about 3.5 weeks. Okay, and so this thing only lasts days and weeks. So when we have a fear of getting killed operating in a shorter time frame, we can call them, there are many names for them. They call them pullbacks, retracement, impulse wave, whatever, what have you. And if you look at it, they are really fear of getting killed, because I draw your attention to these two yellow rectangle. You see that one red candle? In this case, the first one, I'm going to put a red arrow over here. Everybody see that? So in this case, the market basically just goes straight down for that whole day. Okay, and why is people keep dumping the stock like that? I mean, we're still in the overall bull market. If you look at it, now looking back, it's obviously still in the bull market. If you have a long position, why everybody getting out of position? Because for some reason on that day, a lot of people, the market participant, they all experiencing, they all feeling the fear of getting killed. They don't want their long position to turn into a huge losses. So everybody just sell. Okay, and then again, we have a few days later. This time I'm going to label with a blue up arrow. Everybody see it? Another huge down candle, red candle. Okay, that means everybody's dumping the stock. People in the market, those bulls, people who hold long position, they are experiencing genuine fear of getting killed, the position turning to nothing. So everybody was dumping it like crazy. Even though a few days later, as we look back right now, everybody could see it, right? The market proceeded to go up nicely. Okay, because the moment when the fear of getting killed subsides, okay, the market turn around. So in reality, if you think about it, fear is the only rational explanation for all these dramatic moves in the markets. Okay, so what can we do with this information? What can we do with, now we knowing these kind of things, what can we do with them? Well, very important. Number one, learn to recognize the fear of getting killed and or the fear of missing out in yourself. Okay, when you put on a position, first of all, ask yourself, am I putting this on because I'm experiencing a fear of missing out? Okay, because I see the stocks been going up and up and up and I'm not in it, so therefore I gotta jump in. So is that rational? Ask yourself that. Or you basically acting out of fear of missing out. And secondly, sometimes when the stock drops so much already, or sometimes the stock just started to drop and you still have a whole position, it hasn't touched your stop loss point yet, but because you hear it from the news or hear from people, or this report that it's really bad, the stock gonna drop out of bed, or you worry that if you take it overnight, and then you start to imagine all this fear in your head, you start to conjure out the fear of getting killed, so then all of a sudden you dump this position too early, only later on to come back. Okay, so recognizing this, recognize them in yourselves, so you don't make these irrational, fearful decisions. And also, by the way, guys, when you are making decisions from a place of fear, I bet you it doesn't feel good. Okay, now step one, once we recognize them in ourselves, what we got to do next is that now recognize them in other people's and in the markets. Okay, and it's obvious, it's clear. Like let's go back to this chart again. See, again, let's go back to these from 2007 to 2009. Looking back and also experiencing it, we all know, there was a huge housing bubble bursting. We now call it a Great Recession. We can all recognize that there was a huge fear of getting killed being experiencing by the society, in fact, by the world as a whole during that period of time. Okay, everybody thought, the financial system is so close to collapsing. That may or may not be true. Okay, looking back, of course, right now it's easier, but then we can, experience that. There was a lot of Eurozone has a lot of problem. America has a lot of problem. Emerging market has a lot of problem. So we all collectively experiencing that. Now, just because we are experiencing, I'm not saying the fear is not real. I'm not saying the risk is not real. Actually, let me rephrase that. The risk is real, but the fear doesn't have to be. Okay, we have to be able to act in spite and despite of fear. Okay, yes, the market, the condition, fundamental, everything could be bad, but we don't have to act the position of fear. But so we recognize there is fear in the marketplace, and we can be ready to profit from it. Okay, or at the very least, step away, step out. Don't let it bother you. Don't let it affect you. Okay. So, okay, that is the advantage that we have by understanding these two powerful emotions, fearful emotions that are really driving behind all the market behaviors. Because when people are gripped by fear, they act irrationally, and sometimes it's just very hard to get out of it. Okay, and so recognize that, and this happened over and over and over again. As mentioned before, they don't only happen in a longer time frame, they also happen in a shorter time frame. Sometimes they happen within the day. If you're a day trader, I'm sure you will experience that from time to time. Maybe it happens only for minutes, and for just an hour or something like that. Okay, now next thing, let's take it to the next step. Okay, the next thing I want to talk to you guys about is this. The heading for this topic right now is competitive fortune telling is hard. Okay, competitive fortune telling is very, very hard. So what do I mean by competitive fortune telling? Okay, for vast majority of us, myself included from time to time, sometimes for us, trading is really become an activity of fortune telling. We are trying to predict where the market is going to go next. Okay, we try to figure out what the tomorrow's price is going to go. In fact, if you look at YouTube, there are many videos here, many channels here, and you go on websites, you go on, internet, go on a whole bunch of things. The people try to sell you systems. Okay, people try to tell you, tell you ways to predict the market. People try to, if you go to their seminar for a few $1,000s, you buy this trading system, you do this analysis technique, and they promise absolutely, once you master their ways, they can tell you what tomorrow's price is gonna be. Okay, they can find. They can pinpoint down to the last point. They are even asked saying that, the only way you need to make money in the market is to be able to tell tomorrow's price. No, not true. Okay, we'll talk about that later. But basically, what you are doing by trying to predict tomorrow's prices, what you're doing is engaging in activity of fortune telling. Okay, and now why do I call competitive? Because you know why? Not only you are doing it, everyone else is doing it as well. So that's why it's a very competitive sport. So not only you are trying to try to predict tomorrow's prices, so is everyone else. So that's why you are now, all of a sudden, you are not a trader anymore. Okay, you will become a competitive fortune teller, and it's just so ridiculous. It's so funny. And let me tell you this right now. Okay, as anyone who's been doing this thing long enough, or a true professional will tell you, competitive fortune telling is very, 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 very hard. Okay, let me repeat that. It's very, very hard. Yes, there are people who are lucky enough who can get it right for a short period of time. But I guarantee you, over the long run, okay, just like bookies in Vegas, houses always win because there's nobody lucky enough. There's a building advantage to the houses. When you trade, the games, you have to pay commissions, and they are slippage to the market makers. So over the long run, you are at a disadvantage. Okay, you are at a disadvantage. Those people, who are consistently successful over a long period of time, okay, they have an edge. And that edge, more often than not, has nothing to do with fortune telling, has nothing to do with predicting tomorrow's stock price. They either, realize something about the fundamental natures of the markets, like what I'm telling you right now, these two fears that are driving the markets, or they also master other aspects, okay, of the markets. Otherwise, they cannot be successful for long term. So I want to drill this point into your head. Going forward, now knowing what you know, okay, I want you to ditch this idea. Try to be a competitive fortune teller in the markets. Okay. So now let's dig even deeper. We mentioned this before. Now knowing that fear can grip a human being at any moment in time, and us collectively as market as a whole. Number one, we should never ever make a decision from a position of fear. That means no making decision from the fear of missing out or from the fear of getting killed. That's why the saying called, plan your trade and trade your plan. And once you have that, okay, that's a first step toward not being trading from fear. Okay, so instead of making decisions from the position of fear, let's try to make decisions from a place of clarity, rationality, and perhaps even some degrees of serenity. What do I mean by serenity? In my definition, serenity is freedom. Freedom from what? Freedom from fear and anxiety. Yes, we can never have absolute certainty when it comes to the market. But guess what? We can at least have some measure of serenity, of some degree from fear and anxiety. And in order to do that, you first must recognize and understand the place that fear plays in all of us when it comes to trading. Okay, finally, before we end this video, I want to leave you with this quote. There's a great trader named Seykota. He has a very famous quote. He said that win or lose, everyone gets what they want out of the market. Let me repeat that again. Win or lose, everyone gets what they want out of the market. So that means if you lost money to the point that even you blow yourself up, you blow your entire account, it's because you want it that way. Okay, so you manifest your subconscious desire or conscious desire sometimes in the markets. If you win, it's because you want to win. Now, I would like to know, do you agree or disagree with this quote and why? So please let me know in the comment section below if you agree with this quote. Win or lose, everyone gets what they want out of the markets. So I thank you for taking your time to watch this episode. And if you'd like to see more videos like this with this kind of topic, please hit subscribe and like. Thank you very much, and I will see you next time.